Welcome to the Times of Industry show. We're very glad to have back on the show Jason Bodner, and the website is mapsignals.com, and the service that he has founded follows the moves of the institutions into certain stocks, and the idea is to know this well ahead of when it's becoming public information on the F-13 filings or otherwise, and they also follow the company reporting insiders, and they just trying to gauge, is there any sophisticated investor or institution that is moving in and out of stocks before it actually becomes public information, which is very valuable information, especially for momentum traders and people that want to get in on companies that have a spike in price or volume due to or thanks to a heavy buyer that comes in. So 2018 has been a truly interesting year to be an investor and to be a trader, since almost 90% of global assets tracked are actually down this year. So holding cash is it's been the good form of investment this year in retrospect. And on today's show, what we'll do is we'll go over specific companies, we'll go over how to align with superior CEOs, and how to find specific investments that I've personally made this year and similar to them, that Jason will run through his system. And the idea is to have a very content-filled show. So, Jason, first of all, it's always a pleasure. I'm thrilled to have you back on the show. Thanks.
Thanks as usual for having me. I appreciate being here.
You know, Jason, I want to start off with long-term investments. I've been watching, in preparation for this interview, I've watched, I think for like the 10th time, several of the documentaries produced by BBC and HBO about Warren Buffett and his success, his career, his rise to becoming one of the richest men ever. And he has mastered the skill of buying businesses, whole businesses, or equities, and picking ones that have a really outstanding competitive advantage. He calls it the moat. Basically, going back to to the medieval days, the castles used to be built, and then the aristocrats used to build a water moat, just a little barrier between them and the mainland, so that people or attackers would not be able to attack the castle. So that's what he likes about businesses. He likes to find businesses that have this moat around it. And the average investor today, contrary to all the information that is out there, and contrary to all of the billionaires that hold for the long term and buy businesses and act as a business owner, most people hold stocks for a period of less than 6 months. If you look at the institutional investor, it's not the same thing, but for the retail investor, I mean, Apple can run 2 shareholder meetings annually, because every 6 months they have an entire different ownership base. And I want you to kind of share with us why you think the public isn't learning from Buffett. When you worked on Wall Street, did they trade in and out of stocks as if the underlying business meant nothing? Were they looking at these tickers as if they're a roulette?
Wow, that's a great question. And there are so many answers, but let me answer the last part first. When I was when I was working on Wall Street, we had all different types of accounts. So you would have quote unquote fast money accounts. They would come in, buy, sell, move things around just to try and make quick return without real regard for the business. And then you had sort of these more stable institutional accounts like sovereign wealth funds and big accounts like Fidelity or, major money managers. And they tended to invest more in the philosophy of Warren Buffett, a longer hold. But I think, Lior, really what you're talking about is the difference between speculation and investing. And Warren Buffett clearly is one of the longest term investors out there in terms of his mindset. Now, the truth is, why is the public not learning from Warren Buffett? And the answer is the brokerage houses. And the truth is, Schwab, TD Ameritrade, and all the major brokers do not make money unless people are trading. And the more people trade, the more commission they earn. And the more that the news headlines gets people addicted to, Kramer and CNBC, where you're hanging on every word and making your investment decisions on a daily basis, the more money these brokerage firms make. So it's in the industry's interest to have people to churn their positions constantly, because it creates more volume for the brokers, for the exchanges, and everyone on down the line. And then people are hanging on the words of the news media. And one interesting thing that Warren Buffett had said is he likens his investments to a house. And he made the analogy that if you bought a house and you're living on the street, and all of a sudden the value of your neighbor's house went up 5%, does that mean you're rushing out and trying to sell your house the next day and buy it back cheaper a month later? People don't view it like that, because they view it as a long-term investment. And that's how he views things. So I couldn't agree more in terms of picking up on companies with moats and unique businesses and dominating positions in the landscape. They may be unpopular this week, or this month rather, the FANG stocks, but no one can argue that Facebook, Amazon, Apple, Netflix, and Google have very unique business models, moats, long-term viability, and huge, very profitable businesses. So someone like a Warren Buffett would probably be looking to find attractive entries on those stocks, like now, after they've been.
And I'll tell you what, in the latest shareholder meeting in May, he said that Amazon was a big, big miss for him, and he just missed it. And with regards to Apple, I mean, the guy, they own about $57 billion worth of Apple. They're, if I'm not mistaken, they're the largest shareholder right now. So they are thinking that this is a very, very good company with a very loyal consumer, which is the moat. But Buffett also thinks that all the Apple products are underpriced. He thinks they can raise prices easily. And yeah, I know exactly what you mean with regards to the house. He usually makes the comparison with a farm, and he says if you buy a farm and the next day it rains, do you sell the farm?
Yes, yeah, you're right. It was the farm, exactly.
And he also talks a lot about the fact that farms are not quoted daily. Stocks are quoted daily, but farms are not quoted daily. And if they were, will you be, buying and selling the farm? It all goes back to Security Analysis, the famous book from Benjamin Graham, his original mentor, where in Chapter 8 he talks about Mr. Market, a manic depressive, basically a person who comes in every day to the market and screams out quotes, and he just says, hey, let the market serve you and not become a victim of it, which means that you need to look at what Mr. Market is doing and think, hey, do I want to join the madness, or am I panicking here, am I bullish here, and just work off of other people's irrationality and not become a part of it. I want to ask you a second question. Your niche is in finding companies that exhibit irregular institutional activity, but it actually means that either there's a great famous buyer or someone who's very successful over time, and that's a great sign for somebody who's had a lot of success to making a very aggressive position into the company. Into a company that does well, or on the flip side, is someone liquidating, and is there a rush to the exits? And you also track some insider action. It's a great strategy. In fact, a month ago, I decided to become a long-term shareholder of Starbucks. It's one of the best ways, in my opinion, to gain exposure to the Asian middle-class explosion. Starbucks is actually opening nearly 6 branches a week in China right now, so it's about a branch every 16 hours. And anyways, I got in at about 57 and at $57, and then a few days later it was announced that Bill Ackman, who's a billionaire hedge fund, he disclosed a $900 million position, and he said, hey, the stock, in my opinion, will double in 3 years. Obviously, shares popped a little bit, and now they're already at 68, not a month later. So as we're recording this, I just felt that strategy on my own skin, is what I'm saying. Can you talk about how your system is designed for people to understand its worth?
Yeah, it's so cool to hear you say that, because that is almost exactly what we look for. Not always is it on such a huge, massive scale as $1 billion position in a stock, but back in the days of Wall Street, when I was handling large institutional orders, we would get accounts, a lot like Bill Ackman would come in and they would try and mop up every share. And there's something interesting. The SEC requires a filing. It's a 13D. When you take a material stake of ownership and you own more than 5% of a publicly listed company, you have to tell the public. And you have to do it within 10 days once you cross that 5% threshold. So what did these companies start doing? These big investors would come in and they try and mop up as much stock as possible. But when you're buying $1 billion worth of stock, it's very hard to do it on one day, even 5 days. Maybe it takes you a month to build a position that way. So as more time goes by, you're fighting yourself accumulating this massive position. So what they do is they try and quietly buy up as much stock as possible until they get right up next to that 5% threshold, and then they push it right over the line. Then they have an additional 10 days with the SEC to continue to build their position. So I was handling trades like of this size, and that's what turned me on to thinking about the market in this way, because I actually handled billions of dollars worth of these orders, and I would see what would happen to the share price. So, all of a sudden, a few days have gone by, the stock has rallied in a big way, and the news is trying to figure out who it is. And it was actually someone like myself who was moving the stock. So you mentioning that you had that happen to yourself on Starbucks is just really confirmation. So while I was handling these big orders, I realized this must happen daily across thousands of stocks. You just need to know what to look for. So I spent years programming algorithms to try and find this type of unusual institutional trading activity to give us a heads up when institutions are moving in and out of stocks. And then the whole strategy is to further refine that pool by saying, well, let's pick the best stocks with the strongest fundamentals and the strongest technicals. And if the biggest institutional investors, so I believe, are buying those, then that just gives us an even better probability for a winning trade over time.
Yeah, and that's very, very interesting. And what I want to ask you is, do you think this system is better for traders who are looking to make an investment for the duration of a year or less? Or do you think this is for investors who are looking to make a position for 2 to 5 to 10 years or even longer than that? Because once the filings come out a few months later about the disclosures that all of these gurus have to make, the public knows about it. So this is public information a few months later at any time. So can you share what is the worth of this system to know this before it becomes public information?
Yeah, well, the short answer is that it really works for both traders and investors, I should say. For traders, it's not usually going to work within a week or so, but if you have, say, a 9-month time horizon, typically that's kind of our sweet spot for a lot of these trades that have a momentum component into it. However, if you have an investor mindset, our biggest winners came over years. But you did get a big tip-off in the beginning when there's a flood and a rush of institutional money into a stock. To your point on the last question, typically those guys are not looking to hold it for a month and then sell it later. They want to realize a 3, 5, 10-year investment, and that happens over that long period of time. So like one example might be an NVIDIA. We were getting institutional buy signals a long time ago. But the most recent, a good example might be in November of 2016, we started getting signals, I think, as far back as January of 17. The stock was $77 and it rocketed, near to 220 over the course of a year. So that's a great trade. However, we were getting signals all the way back when the stock was trading around $22. So that's a tenfold return, but it's a much longer time horizon.
Sure. And if we're talking about the difference, I mean, the difference between making from 22 to 200 and something or $300 per share, where Nvidia ended up being in 77, that's a massive difference.
That is a massive difference, and that comes to the philosophy of a trader versus an investor, because a trader's going to be going for the high probability. I want a good chance of making a small or reasonable return over a short period of time. So there's going to be tight risk, and you're going to be really managing that risk. Cutting the position early so you can preserve capital or use it elsewhere. Whereas
go
the
for
investor,
base hits and not home runs.
Exactly. You're going for singles and doubles. So the investor, when you're looking for the grand slam, one of the best analogies is Babe Ruth was the all-time home run record holder, but he was also the record holder for strikeouts. So that means he swung for the fences on every single pitch. And he had the most strikeouts, but the most home runs. So that's sort of that investor mindset. When you're looking for those big gains over the long period, you can still use that tip-off of a flood of institutional money coming in to give you a good chance to sustain a return. But then you got to sit through more volatility with that mindset. And that's harder to do for some people, so they prefer the trading mindset. Clip off those singles and doubles, like you said.
So what I would do if I was using the service, mapsignals.com, I would do my own research regarding a company, my own process that already works for 18 years, but then amplify it with asking myself, hey, is there any unusual activity happening right now with an investment that I like at this price? And the reason I would use the service is to say, okay, let's say I want to put $100,000 into a given company, and I want to spread it over time. Should I be aggressive right now, or should I be aggressive a little bit later? And this is where a service like yours can amplify. Is there some urgency right now? In the case of Starbucks, if I hadn't acted when it was 57, my maximum buyout price that I wanted to get in was 58.5. So a week later, and that investment would be shut to me. So this is where, hey, if this stock is already close to your maximum buyout price, there's a good chance that you want to know if there's any institutional activity right now, so you can position yourself later. And we always talk about this at the letter about position sizing and then splitting your purchases over time. In other words, if you buy a company, if you buy an investment, you don't need to buy the full position outright, because there might be a chance that the momentum is still down and you might get a better entry price in the future. And there might be a probability that you won't. And therefore you want to stake your claim, but it doesn't mean you need to already put the entire position in there. Nobody ever died from small profits, as they say. Here's what I want to ask you, Jason. For people who do not have the time, or do not wish to spend the time, or just do not have the skills to research specific companies, go over their financials, think about their competitive advantages, look over the entire industry, do the entire process. Is it prudent for them to just buy the index fund, let their money grow without a lot of fees, without a lot of bells and whistles, let them grow with corporate America, an idea which has had tremendous results over time, to the tune of about 8% a year going back at least to the beginning of this the 20th century. This is an idea that generates doubling your money about every 7 years, and I don't have to tell you about all the stories about the millionaire next door, or the guy who's a low-level employee at a company and just saved over time and bought the index, and at 65, you see a person who has a few $1,000,000. So let me throw the mic over to you and share with us through your experience in Wall Street and through seeing the performance of average investors, retail investors. Is it just better to give up the game and go with the surest thing possible, which has been just to be long America?
Wow. Okay. Another two-answer question. Great question. The first answer I want to give is back to the notion you were just talking about prior, whether you piecemeal or you dive right in, and using my service to find institutional activity, unusual institutional activity. The truth is, I never know exactly why or what is happening until it becomes public. And often by that time, it's too late, sort of as you just alluded to in Starbucks. We had a situation where one stock came on my screen. The ticker was BIVV, and the stock was BioVeritiv. And it came on as a buy, and literally within 5 days, it was announced as a takeover target for 60% premium. So the stock went up 60% in a week. So that would be one of those cases where you would really wish you had dove right in. But then on the flip side, you get the cases where it doesn't always happen that way. But from my philosophy, when I get these signals, they're highly reliable. So I want to act, with the highest conviction possible. And
Jason, just to stop you there and ask you, how often do you get such reliable signals? Just so we can understand this, how rare is this that you would get a signal like that has such a good response a few days later?
Well, to give you an idea, I look at 5,500 U.S. stocks every day, and at the end of the week, on those 5,500 stocks each day, I get about 100 unusual institutional activity signals. About a third of those are sells, and 2/3 of those are buys. And that's the average over decades of data that we've acquired. So out of those 66 buys, let's call it, only like 5 or 10 meet my really stringent fundamental criteria. So after a week of looking at 5,500 stocks a day and 100 signals, I end up with a buy list of about 20 stocks. So it's really rare, and it's really selective, my process. But that is why I have a very high probability. We have near a 70% win rate on our trades over a 9-month holding period. And that's what we've tested going back to January of 1990. So in answer to your question, they happen every day, but the really good ones with the really high probability of fast gains, those are obviously only a handful. But you can expect over 9 months out of a list of 20 that you would have about 15 or 14 trades that are going to work out positively, better than the market. That's what return profile we see.
Well, that's interesting. First of all, that you say that the 70% success rate is not success in the fact that they've gone up, but they've gone up and outperformed the market. So that's a very high standard going into it as well. Just so everyone's aware. Now, we've had guests on, Jason. If you listen to previous shows, we've had guests on that have called the top for the bull market. They basically say the bull market is over. Topped in January of this year, and they're looking for a 30 to 40% decline in the overall market, while others on the other camp altogether are saying, hey, the mania is still not here, the millennials have not gotten in, the baby boomers are not bullish, there's no retail participation yet. This is not the mania, this is not the dot-com era. This could really take fire once some good news from the trade war blows off some steam, and we see that the two largest economies in the world are moving in the right path, some sort of a news cycle that will, kick off a more euphoric stage, because right now mainstream media and everyone else is frightened. You see the smart money index is plummeting. All the fund flows are out, and this is definitely not euphoria. So what these people are saying is, hey, euphoria is not here yet. This is not how bull market ends. It doesn't matter that it's almost 10 years old. What matters is that we haven't seen the bubble phase. We haven't still seen the end. So in what camp are you at?
Well, I'm pretty much in that camp. First thing I want to say, just to rewind, I would, if I don't have the time and energy to research stocks, I would buy an index fund, because, again, to evoke Warren Buffett, you stick your money in that and you look at a 100-year chart of U.S. stocks. That's all you need to know. So you can very passively earn a nice return. As far as which camp I'm in, I agree. I'm personally bullish. When everybody's bearish and the fund flows are out and all the news is negative, that's probably when you want to be buying. Again, Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. All we have to do is look at the fundamentals of the market, which are phenomenal. We're having a third record quarter of sales and earnings growth. I think as of today, it was like 9.3% sales growth and 28% earnings growth on the S&P 500. I mean, those metrics are just phenomenal. So maybe people are afraid that we're at the peak growth momentum. But even if things start to fall back, we still have a very strong humming economy. We have record low taxes. We have record cash patriation coming in from overseas, and a record amount of share buybacks from U.S. corporations. We might have $1 trillion of U.S. buybacks this year alone. We have a strong dollar, which benefits small and mid-cap companies domestically in the U.S. And, we have record profit margins. So I don't know why everyone's in such a bad mood. I think the truth is, it's easy to be bearish and call the end of the world, because you can be wrong and people will forgive you when everything's going up, but you look great when you're right. But the truth is, I agree. I would like to see that phase where the cab driver is showing you his Schwab account on his mobile phone and getting a call from his mother asking him about stocks. That's probably when we're going to be at the end of the bull market. So what we're experiencing right now is sort of a lack of liquidity that started with uncertainty about the trade war, which you just mentioned, and midterm elections, which is now in the rearview mirror. We just hit an air pocket in the market where things are very volatile. We just have to get this out of the way, and usually we rally into Thanksgiving and year end, and I'd like to see companies start getting rewarded for all these phenomenal sales and earnings reports that we're seeing. So I think we have plenty of room to run. That's the camp that I'm in.
Jason, how worried are you on the flip side about a $21.5 trillion national debt, which has higher and higher interest rates to service it in the last 3 years, and then seeing that the Federal Reserve is not accommodating any more of the bond purchases. In fact, they're shrinking their portfolio and basically allowing the free market or the foreign holders to decide the interest rates for the bonds. And just in general, how worried are you about a $1.3 trillion 2019 projected deficit, and just the recklessness of the imbalance between the tax receipts that the Washington gets and how much they need to pay out over the long term?
Well, the one thing President Trump is historically in his businesses used effectively is debt. And, here's a guy who's not afraid of declaring bankruptcy, but I don't think he would ever employ that for the United States. So I think he views the use of debt as a tool to finance growth. So while that is a staggering sum, and it is a little bit disconcerting, I'm not in the doom and gloom camp that, we're going to be in a situation that we can't recover from, because I think in his mind, he's still using the mindset that we're the strongest economy in the world. And therefore, we have those sort of laurels to sit on going into the future. Now, in terms of sort of shrinking that balance sheet, Wall Street may not like it, but in fact, it's better, right? Because eventually the piper's going to have to get paid, and if we keep on taking on new debt and growing it, it's an inevitable sort of bad end, which is, I think, what you're alluding to. Some of your, discussions have come to that conclusion. So the real answer is I'm not that worried yet. I guess it'll be really worrisome when we've reached that tipping point, past the point of no return. But I don't envision the powers that be letting sort of all of our financial society and modern society come to a crashing halt by being that reckless without some sort of plan of action. Now, I don't really know what that plan of action is, but for now, I still remain bullish on U.S. stocks because we're still making more money than ever before. But as rates go higher and taxes might face further reform in the future the other way, there are going to be ways to sort of combat that debt. But I guess I would like to see a little bit of moderation and not growth in the debt column. But for now, I'm not too concerned.
Jason, is there a lack of opportunity in America today, a lack of leveling the playing field? Do you think that the middle class and lower classes have been stripped from some genuine ways to get ahead? As the American dream gone, basically, and we're in sort of a wages prison where people cannot get ahead real quick as they did 20, 30, 40, 50 years ago, the generation that came after the World War II, and they had so many opportunities for growth in America. Do you think that it's much harder today to start at the bottom and get to the top?
I do. Sorry to cut you off there. But I do, because post-World War II, America was a producing nation. We produced cars, we produced steel, coal, energy, technology, which at the time was industrials, right? Boeing and airline was high tech, but it was really an industrial stock now. Now, over the course of decades, we've switched to a consumer society. Everything we do is based around consumption. And then for the people who don't have the disposable income to acquire the tangible material goods that they want, we have creative financing by banks and credit card companies. So without significant, real, measurable wage growth and an increase in consumer debt, it is much harder for people to get ahead because there's this inherent debt that didn't exist in the time period that you were referring to. So people didn't graduate college back then with massive student loans and credit card debts because they got credit card offers while they were in college and didn't have enough money to spend on beer. So they put it on credit cards. I think when you matriculate out of higher education now, everyone's saddled with debt. They're forced to get jobs to pay for that debt, and there's no real wage growth. So I do think it's harder. However, we still live in the land of opportunity, and America does represent the best, strongest, sort of safest economy in the world. So it is still a society that very much rewards hard work. It's just harder to come by than it used to be, like you pointed out.
I think the economy is become more specialized. In other words, it rewards people with very special skills in a disproportionate way. In other words, you can become a millionaire, a multimillionaire, even a billionaire in a few short years if you're onto something very special. And on the flip side, it doesn't reward anymore just good old labor. It just sustains a living standard, whereas it used to be that both were rewarded, but the specialized skills did not have a global opportunity that easily. In other words, a guy like Jeff Bezos that can become in 20 years worth over $100 billion because of a specialized skill that he has developed in a special company. Whereas, as you see, the minimum wage with this company is $15 per hour, and that's after a lot of public outrage. So it's an amazing generation that we're moving into, where any company can become a global company in a matter of a few short years if you have something real special. But on the flip side, there's a lot of skill that stays on the sidelines because many of the jobs do not require an insane amount of skill to perform. I'm sorry, you had something you want to contribute to this?
I was going to say, I think it's so interesting what you're saying echoes your very first question of why do investors not learn from Warren Buffett and they are trading in and out. I think our entire society has become geared towards instant gratification with instant media, instant news, tweets, videos, instant profits, social media influencers making hundreds of millions of dollars for arguably no contribution to society whatsoever. People expecting to make their retirement in a year and not 30 years. And, now what you're saying, it fits right in line with that, is basically in the labor market. Gone are the days where you work 30 years towards something and get rewarded over that time period. Now, people hope to be, a couple of years ago, the next big augmented reality startup and sell it for $400 million in 4 years. So I think you're right. I think it's really interesting.
Now, where can people find more about, the services that you offer?
Yeah, so our website is mapsignals.com. And basically, as we went over, we look for the winning outlier stocks that are being traded in an unusual way. And we measure those signals and we come up with stock ideas surrounding that. And then we also measure the market in general and the sectors based on those signals. So if you head over to mapsignals.com, you can check. We had a blog entry, I believe it was October 26th, around there. We said the market was oversold. So the first time, Lior, you and I spoke, we had sent out an alert saying the market was overbought on January 24th, and then it proceeded to fall 13%. Well, this time we sent out a report to our clients, put it on our blog, and the market proceeded to rally, I think at its peak, 7% from that report. So institutions moving in and out, and again, we created algorithms to try and replicate this, is a very good measure for what the market might do in the future. And we keep finding that time and time again, and that's the basis of our whole process.
Perfect. Hey, Jason, thanks for taking the time. Great interview, and you covered a lot of ground. Would love to have you back at some point in 2019 for sure.
Great, Lior. Thanks so much, and happy Wednesday over there. And I appreciate you having me.